What drives farmland values? Supply or demand? Imagine trying to buy a piece of land where the soil is rich, water is plentiful, and the location is prime. Now picture that land being in short supply. What do you think happens to its price? That's what we're here to figure out. When it comes to farmland prices, two main forces are at play: supply and demand. Both shape the market, but understanding which one has the bigger influence can help you make smarter investment choices. Let's start with supply. If there's only a limited amount of farmland available, prices tend to go up. This is especially true in regions where land is hard to come by because of urban development, land use restrictions, or environmental protections. When farmers want to expand their operations but can't find enough land, they're willing to pay more. This scarcity pushes prices higher. On the other hand, if there's a lot of land for sale and few buyers, prices usually fall. So, supply acts like a baseline, setting the floor for land prices. Now, demand is equally important. Farmers looking to grow their operations want to buy land that can produce good crops and generate steady income. When crop prices are high and input costs like seed, fertilizer, and fuel are manageable, farmers are more eager to buy land. Their confidence in future profits makes them willing to pay more. Investors also drive demand, especially when farmland is seen as a safe, long-term investment. When interest rates are low, borrowing money to buy land becomes cheaper, encouraging more purchases. This increased demand can push prices even higher. Demand can also be affected by regional rules. In some areas, restrictions limit who can buy farmland, which can slow demand. But in regions where investors, including corporations and non-local buyers, can easily purchase land, demand often rises. Soil quality, water access, and location also influence how much buyers are willing to pay, adding more layers to demand. For those analyzing farmland markets or planning investments, it's vital to watch both sides. If land is scarce and demand is high, prices tend to climb. If there's plenty of land but little interest, prices may drop. Changes in crop prices, input costs, interest rates, and land policies all impact these forces. By keeping an eye on these factors, you can better forecast how farmland values might change over time. In the end, farmland values are shaped by a tug-of-war between supply and demand. When supply is limited and demand is strong, prices go up. When supply increases or demand wanes, prices tend to stabilize or fall. Knowing what drives these changes helps investors and market analysts make smarter decisions in the agricultural real estate world.